Hey everyone, welcome back. Today we're looking at a major insider trading case involving a former senior Bank of America investment banker, his longtime friend, and an alleged $18.5 million profit tied to the $8.1 billion acquisition of South Jersey Industries. The U.S. Securities and Exchange Commission, or SEC, filed a lawsuit on Friday, August 21, alleging that former Bank of America banker Jason Schatzky improperly tipped his longtime friend and former colleague Gavin Wolf about a potential acquisition before it became public. According to the SEC's allegations, the story goes back to late 2021. At the time, Schatzky was Bank of America's co-head of America's Power and Renewable Energy Banking. His team was advising South Jersey Industries, an energy holding company. The SEC alleges that Schatzky had access to confidential information about a potential transaction and shared that information with Wolf, a friend he had known for more than 20 years.
Wolf runs Evergreen Capital, a firm that manages family assets. According to the SEC, Wolf then purchased more than 2.2 million shares of South Jersey Industries, spending approximately $53 million. The timing of those purchases is at the center of the case. The SEC says Schatzky and Wolf communicated multiple times about the potential acquisition during late 2021. One particularly notable interaction allegedly occurred on November 9, 2021, when the two men and their wives attended a nationally televised college basketball game between Duke and Kentucky at Madison Square Garden. The SEC alleges that Schatzky had luxury box seats through his connection with Bank of America, and that the two men discussed the potential transaction around this period. Several months later, on February 24, 2022, South Jersey Industries announced an $8.1 billion buyout. According to the SEC, Wolf's investment gained approximately 36%, generating about $18.5 million in profit. And that is what makes this case so significant. The SEC is not simply looking at whether Wolf made money on a successful investment. The regulator alleges that the investment was based on material, non-public information provided by someone who had a duty to keep that information confidential. Insider trading cases generally focus on whether confidential information was improperly obtained or communicated and then used to trade securities before the information became available to the broader market. But there is another important side to this story. Both defendants strongly deny the SEC's allegations. Jason Schatzky's attorney, Robert Anello, said Schatzky strongly denies the SEC's claims and is confident the evidence will show that he acted properly. His lawyer also specifically denied that Schatzky provided Wolf or anyone else with material, non-public information about South Jersey Industries. Wolf's attorney, Reed Brodsky, also said his client categorically denies the allegations and will vigorously defend himself. According to Wolf's lawyer, the SEC has overlooked sworn testimony and documents that allegedly show Wolf purchased South Jersey shares based on what his legal team describes as an independent investment thesis. So at this stage, these remain allegations made by the SEC, not established findings of guilt. The two men also have a long professional history. Before joining Bank of America in 2012, both Schatzky and Wolf worked at Credit Suisse in the power and renewable energy banking business. Schatzky was 59 when the SEC filed the case, while Wolf is 55. The SEC is seeking several forms of relief. That includes recovering what it considers to be ill-gotten gains from Wolf, along with civil financial penalties and officer and director bans against the defendants. Those restrictions could potentially affect their ability to serve as corporate officers or directors, depending on what the court ultimately decides. There is also an important point for Bank of America shareholders and investors. Bank of America itself has not been accused of wrongdoing in this case. The bank confirmed that Schatzky is no longer employed there. The SEC says Bank of America terminated him in March 2025. So the allegations are specifically focused on the conduct of the individuals involved, rather than accusing Bank of America of participating in the alleged insider trading. What makes this case particularly interesting is the combination of the alleged communications, the timing of Wolf's purchases, the enormous size of the investment, and the substantial profit following the acquisition announcement. The SEC will now have to prove its allegations, while Schatzky and Wolf have indicated that they intend to defend themselves. For investors, the broader lesson is straightforward. When confidential information about a major merger or acquisition is involved, even a private conversation between longtime friends can become highly significant from a securities law perspective. A trade can look like a brilliant investment decision after the fact, but regulators will examine what information was available to the trader, where that information came from, and whether it was public at the time. This case is still developing, and the final outcome will depend on the evidence presented in court. So for now, the key facts are these. The SEC alleges that confidential merger information was passed from a former Bank of America investment banker to a longtime friend. That friend allegedly bought more than $53 million of South Jersey Industries stock, and the SEC says he ultimately made approximately $18.5 million. Both men deny wrongdoing. We'll have to see how the case develops and whether the SEC can prove its allegations.
Thanks for watching. Stay informed, stay objective, and as always, do your own research before making any investment decisions.